Hello and welcome. Thank you very much for coming by. Got a couple of people watching, so hey, welcome guys. I have to do the introductory thing because I never do that. So my name is Peter Redlinges, and I'm going to be sharing some information with you this evening. So first things first, guys, join the Discord. I can see there are a bunch of you watching the stream at the moment. If you join the Discord, the link is in the comment section below. Alternatively, yeah, that's where it is. If you join, then we can chat and we can share charts and that kind of stuff. So I want to start by asking you guys if you remember, or how many of you actually watched the videos from last week. Can we get some sort of an indication to see how many of you guys watched the what did you think of the whole trend thing, understanding the trend, the 3 phases of the trend? I want to do a bit of a test with you. What we did here is do a little bit of a let's do that and we make it big. Alright, how many of you guys remember this stuff? Just to get some sort of indication. The 3 sort of basic parts of the trend, or the 3 basic types of trends that you get: primary, secondary, tertiary trend. I want to make sure that everybody understands this stuff before we move on, because if there are kind of questions and stuff around it, then we need to make sure that that everybody is on board. But it seems as though there are no questions on the Discord. Oh, man. Sorry, I'm very rookie at all this stuff still. And it doesn't seem that there are any questions on the... Oh, it did not, sorry. Oh, hey, Hendrik, or Heinrich. Hello and welcome. Okay, so basically, Heinrich, just for the sake of catching you up on what happened, we spoke about, or I spoke about the 3 sort of, it was a little bit about Dow theory, and it boils down to, well, one of the pieces of Dow theory is that it boils down to you get basically 3 different types of trends, 3 of them, right? And if you look at that, basically there's a primary trend, a secondary trend, and a tertiary trend. So a primary trend can last anything from less than a year to decades, or whatever the case is. A secondary trend is anything from a couple of days to a couple of months, up to a maximum of say 3 maybe 4 months. And then a tertiary trend is anything from a couple of hours to a couple of weeks. So the basic idea here is that during any sort of primary trend, there may be secondary trends which are counter the primary trend. And within those secondary trends, you could have tertiary trends that are counter to the secondary trend, or with the secondary trend. And that's why you have these sort of wave formats. So what I would like for guys to do today, as we get started, there is a Discord channel. I've been saying it like 1,000 times. I would like for you to, this is what the Discord channel looks like. So there's a whole bunch of things, live stream, a whole bunch of rooms and stuff. So I would like for you guys to, in this Discord, there's a whole bunch of people that have joined it. Not a whole lot of them are online, but I would like for you to, during the course of this, stream, look at charts, your own charts, and basically I would like for you to identify the primary, secondary, and tertiary trend. I mean, this we're going to go for probably about an hour, I'm guessing. It depends on how long it takes, whatever. And then basically at the end of the sort of session, I'd like to then go through some of your charts and then see, we can then go look at, do a chart, somebody pick a stock, anybody pick a stock, do the charts, pop it on the Discord, and then we look at your charts at the end of the sort of stream, and then we see, we just interpret them and see how it goes. So what we're going to be talking about today, if I can get this thing to work. What we're going to be doing sort of today is we're going to be talking a little bit about risk management. Let's do that. Oh no. I'm very very not used to how this whole thing works. I've got too many screens and it doesn't want to cooperate. Now everything's gone black. Oh my goodness. Alright, so let's get back to here. Forgive me, I'm just trying to figure out, I'm trying to play a what do you call it, PowerPoint thing, but it's not working. So what we're gonna do is we're just gonna basically do this and make it big, and yeah, I don't want parallels. Okay. Alright, has anybody joined the Discord as yet? No. Okay, Smart Money Institution, I see you asking about fib retracements. I'm going to write that down so that maybe we can get to it if there is time. Fib retracements. Okay, so basically, last time we spoke about Dow theory, and we remembered our very first rule, which is to get good. Yeah, I got notes in here from this. Is an old presentation template that I used. So the first mission is to get good, right? Step 1, get. Step 2, good. We need to practice, we need to study, we need to do those sort of things. So looking at risk management, this is something that actually was asked a while ago, which was what is the best way, or where do you put your stop losses? So then that led to a series of questions, which is 1, how were you managing risk at this stage? And they said, okay, no, the 2% rule, which is fine. And then the next question is, where do you put your stop losses? If you look at the chart, where specifically do you put a stop loss in order to not get stopped out too early, or whatever the case is, because that was happening to this particular trader all the time, that they were just getting stopped out again and again all the time. So let's look at, we'll start with the 2% rule. We'll go into then something that I call an exposure rule. And then from there, we're going to do a couple of charts, and we're going to look at where to put some stop losses, and that's obviously where I want some interaction from you guys. You got to tell me which charts you want to look at. All right, so the 2% rule. I'm going to move this to the left screen. You are seeing it already. So the 2% rule basically says that you never risk more than 2% of your capital. Now that doesn't have to be 2% necessarily. It can be less. It can be 1%. It can be 0.5%. Some people can use 5%. The basic idea is just for you to be able to sustain drawdown over a period of time without losing all your capital. So you don't want to be in a situation where one trade or take 2 or 3 trades and that's it. That's the end of your account. So what you do before sorry, I'm reading the stuff in the Discord. Hello, Brian. So before you take a trade, you want to work out what is 2% of your total capital. Okay. So if you take, for example, that you have, we're going to open, let's open Microsoft Word. Oh, not that one. Notepad. So if you've got 100,000 Rand in your account, which is maybe a bit big. I mean, we can work with the smaller amount. Let's say you've got 50,000 Rand in your account, okay? Basically what you do then is you say, okay, if I want to risk 2% of 50,000, that's going to work out to 1,000 Rand per trade. So in other words, if I get this trade wrong, I want to lose only 1,000 Rand, because that gives me the ability to get, almost a whole bunch of trades wrong in a row and lose 1,000 Rand at a time, and I've got 50 trades before I'm out of money. Now, in theory, what happens is every time you have a losing trade, your account size gets a little smaller, so your risk gets a little smaller. So you keep doing that calculation every single time. Okay. As your account gets bigger, you obviously keep doing that calculation every single time as well. So what you do is you identify your entry point into a trade. So let's look at, there's a good example actually at the moment, which is Anglo-American. So if you look at Anglo-American chart here, I'm going to move that into the center. If you look at Anglo-American chart, we've had this resistance level here at 335, which if we look back in history, we can see has been a relatively significant resistance level. And the further we go back, the more we can see that even here in sort of 2010 it was resistance, then here it was a bit of resistance, and then turned into support during 2011. In 2012 it was resistance again, and then we hadn't seen that level for a long time, and then now we sort of are back at this support or resistance level, which is hopefully over time going to turn into support, right? So our level is really kind of there. I'll put that blue line in. So as this level now breaks, we now want to take a trade based on the breakout of this level. So the question is, how much risk do you take? So what you do is you identify your entry price. So you say that you want to enter if the stock breaks out and closes a daily trade above, XYZ level, that is going to be your entry point. And then if the stock closes below a certain point, that is going to be your stop loss, right? Sorry, I need to just change this thing so that you can see more of me and less of the wall. So basically what happens now in this situation is that you have to sort of pick where you want to put your stop loss. So we'll get to that because that's one of the questions that we've asked as well, is how do you necessarily pick these things without getting stopped out? But let's say you use 320 as your stop loss level, all right? So I'm just going to draw in a little line there. So let's say you use 320 as your stop loss level. I'll draw the line in there so that it's a bit more obvious. And what you want to do is you want to basically say that if the stock buy it here at 341 Rand because it's broken your level, and if you stop out at 320 at that level, you want to price point 320. If it breaches below 320, you want to stop out. So basically what you're going to do is you're going to do that calculation, and I'll do the calculation here in a little text box for you, right? So you're going to say my entry is 341 Rand minus my 320 Rand stop loss level, all right? That gives you 21 Rand. That's how much risk that you're taking on the stock. A 21 Rand move against you, and you're going to stop out, okay? So now you say, okay, if 2% of my portfolio, because my portfolio is 50,000 Rand big, so 50,000 times 2% equals 1,000, right? So what you now want to do is you want to take 1,000 divided by 21, right? And I'm actually going to use a calculator because I can't do this kind of stuff off my head. They said you need to be good at maths, but they made calculators, so who cares? Divided by 21. So you've got 47, that gives you 47.61, and you can round it off to, let's say, 47. So now you know you can buy 47 shares in Anglo-American, and if you stop out, you will only lose 2% of your money. You'll only lose 1,000 Rand, because this is the way of managing your risk. And this gives you the ability to take multiple trades. So now let's say, for example, you do stop out. What happens now is your portfolio is now 49,000, okay? Because you've now lost $1,000 in your in the process of this one trade. So now what you do is you say 49,000 times 2%, times 2% equals, and now you'll see that your number is a bit smaller. So 49,000 times 2% gives you 980. Okay, so your stop loss is continuously adjusting, or the amount of money that you risk is continuously adjusting to the size of your account. So as your account gets bigger, you're risking more, but proportionally, it's always the same. Okay, and then the same process applies. The same process goes again, and you pick where your stop loss is going to be, and from there you continuously work out what the amount of risk is that you're supposed to be taking in order to manage your risk. Okay, rands and cents. I see you said that you got stopped out of Anglos today. Were you long or short? Yeah, I'd like to sort of see what your trade was there. That would be pretty cool. In any case, so there are a number of pros and cons to using this system, or the 2% rule. Some of the pros are that you can easily manage the risk that you take, right? It's very simple. It's a very quick, easy calculation. It's not, it's not very complicated or whatever the case is. there is lots of room for error. So usually your stops are pretty big, so you take relatively small positions, and you can there's lots of room for the trade to go wrong before you stop out, which is nice. And it helps keep you very objective. So it helps keep you in that mindset of 2-to-1 risk reward or 3-to-1 risk reward, so that you make sure that you never overexpose yourself to risk. The cons are that you can gear yourself too big. I'll get into that. And then too many trades can hurt you rather quickly. So if you just overgear without noticing it, because what you do is you put on a whole bunch of trades, each of them with a 2% rule. You got 10 trades open, and they're all longs. For example, the market comes down 5%, and you stop out of 10 trades, all with 2% risk. That is a big risk. Please will you forgive me for a second. I'm a little sick. I just quickly want to go to the loo and blow my nose. I'm back. Okay. So, oh no. It's now going to play other music. I don't want you to play music. Right. Okay, so you were short Rands and Cents. That is very unfortunate. I think a lot of people were trying to play that game, but there was it was brutal. Like that, you could see Monday, Tuesday there was resistance at 340, and today that closing above that level. I think it depends, of course, what the Fed does tonight, but I think generally resources should continue to run. Anyway, whatever. That's not what we're here for. We are here to learn about risk management. So we now know how to work out risk management. What we're going to do now, we're going to run through this example again. So remember, in our previous trade, we had a 50,000 Rand portfolio. We took a 1,000 Rand loss, and we've now adjusted our risk management a little down. So now we've got a 49,000 Rand portfolio. And now we can take only 980 Rands worth of risk in order for it to be 2% of our portfolio. So this time we decide to trade something else. We decide to trade ShopRite because we're legends and we're risky, and we decide that we're going to short this thing, going into the results because, I don't know, a little birdie said to you that this is a good idea. Personally, I didn't do this. I don't know if anyone else did. I think if you did, congratulations. It was risky, but good job. I didn't do it, so I'm not even going to try and pretend to take credit for that. So anyway, whatever. Here we have a situation where if we look at the ShopRite chart, we say we could probably have a level here at 180. So we're going to run through this whole process, okay? So let's say there's a level at 180 that you could see was a support level in the past. I'm just going to make it 180. Okay, and now that we've had a daily close below that yesterday, that triggers our short. Actually, you know what? You wouldn't have been able to get in this. Anyway, okay, whatever. So we can be. Let's just pretend. Let's say that we got short in this candle here. Okay, and we've decided we're going to use our stop loss. We're going to put our stop loss here above this candle. We're going to put our stop loss at 196, right? 196. Now, what we do is we, once again, measure the distance between our entry price and our stop price. Okay, now you can obviously see here that there's room for slippage. So you say my entry price is 180, but the price you get is not 180. You get 179.50. So you're a bit below. And that extra 50 cents actually makes a difference in how much risk you can take. So you have to be careful of that. So what I usually do is I plan my trades and I say, I will enter this trade in anything 180 and above. If it's below 180, then I won't take the trade, right? If it sort of trades, and then I work out my risk reward and my risk value that I'm going to lose, or the number of shares that I'm going to trade, or whatever the case is, based on where, based on the maximum price or that I'm willing to pay if I'm going long, or the minimum price I'm willing to get if I go short. So in this case, let's say we believe that ShopRite results are going to be absolutely terrible, which they were, and we decide Monday that we want to short this thing because hey, we're only going to risk 2% of our portfolio if we get it wrong, right? So we say this is the support level. We are willing to sell up to $180. and we'll sell at any price. If we get an opportunity to sell slightly higher, then we'll do that. Alternatively, we'll sell at 180, and we're going to stop out at 194. Okay, so what we're going to do is we're going to say 180, and I'm going to use it in cents because it's something that you guys will have to get used to. 180 minus 196, sorry, was our stop loss level. So that gives us 16 Rand, or 16 Rand, right? Worth of risk that we're going to take. So now what we want to do is, once again, we want to take our risk that we're willing to take, 980 bucks, and we're going to divide that by 16 Rand, and that's going to give us 980 divided by 16. That's going to give us 61.25. So we're going to round off to 61. Okay. Now we can short 61 ShopRite shares, and then we know if we stop out at 196, we only lose 980 Rand. Okay. So now this is well and great and amazing, but what it doesn't do is it doesn't make space for not, I want to say slippage, but I don't want to say slippage because I'm looking at things, I'm getting distracted. It doesn't make space for fees. Okay, so let's say, for example, you're trading CFD and the minimum cost is 50 Rand. Okay, or 0.2% of the value of the transaction, right? So what you have to do if you really want to manage risk meticulously is you have to include that in the amount of money that you're willing to risk. Otherwise, you're going to always going to be losing 0.5% more than what your 2% rule is. And if you're only risking 2% and you're paying 0.2% brokerage, so to get in is 0.2, to get out is 0.2, so the round trip is 0.4, plus there's a bit of slippage, okay, so you don't necessarily stop out at exactly the level you want to. And you're risking 2%. Suddenly your losses are closer to 2.5 to 3%, and you're only banking on risking 2%. Your whole risk management model is built around risking only 2%, but your actual loss is coming closer to 2.5, 3%. So this is a common problem that people, I don't know if they pick it up or not. It's something that I picked up. I obviously built spreadsheets to log trades and stuff in. And I noticed that my losses are usually bigger. So what you have to then do is then work out basically what your what the brokerage is that is included, or include the brokerage in the deal. Okay, so let's work on 61 shares. Okay, so 61 times 180. Okay, is going to give us, I just want to work out, because this is a 50,000 Rand account, okay, times 180. That is a 10,980 Rand trade. So that is going to equals the min brokerage fee, okay. So that, because that trade isn't really, it's a very small trade. It's only 10,000 Rand, okay, or 10,980. I just want to double check that. 61 times 180. Whoa, 61 times 180. Goodness. Yeah, okay, 11 grand. So it's not a very big trade, okay? So what's going to happen here is you're going to pay the minimum brokerage fee, and if you trade at, let's say it's 50 Rand a trade, okay? Because that's kind of like what the minimum is. If you're paying more than that, you shouldn't be. So 50 Rand minimum fee to trade CFD on this particular trade. So it's going to cost you 50 Rand to get in and 50 Rand to get out, right? So that's times 2. So it equals 100 Rand. So now what you have to do is you have to include that 100 Rand in your 980. So you can't lose. So we're going to delete all of that, and we're going to say 100 Rand equals fees. Okay. And let's even move that there. Okay. So we can take 980 risk. So Rand 980 equals risk, and 100 Rand equals fees. Okay, to get in and out of this trade. What we don't want to do is risk 1,080, because that's more than 2%. So what we can have to do is we have to adjust the risk to 880 in order to pay the 100 Rand fee. Okay, so now in order to compensate for this, we know that we are taking 16 Rands worth of risk on share price movement. Okay, but we're only taking 880 Rands worth of share price risk, right? The other 100 Rand, we're paying that. That's fees. 50 Rand in, 50 Rand out, right? So we have to then adjust this to 880 divided by 16. So 880 divided by 16 now suddenly gives us 880 divided by 16 now suddenly gives us 55 shares. So we're adjusting our trade. So our trade's now even smaller. But what that's doing is it's allowing us to compensate for the fees, so that if we do stop out, our total loss inclusive of fees is 2% of our portfolio. Okay. If your portfolio is bigger, then you're going to have the problem that it's not as easy to work it out as just plain $50. So let's say your portfolio is 490,000. Okay. So now suddenly 2% is 9,800 Rand per share. Okay. So if you basically are going to be risking 9,800 Rand, we're just going to run this whole calculation from the start. Is risk, and now we need to work out the fees, right? Where's the question mark? Bang, bang, fees. Okay. So unfortunately, we're going to have to do this twice in order to figure out what the fees are going to be. So what we need to do is, once again, say we have 16 Rands worth of risk, and we want 9,800 Rand divided by 16, right? Damn face ID, 9,800 divided by 16, right? So now we are buying 612 shares. Okay, so now to work out your exposure, you take 612 times by 180, which is your entry price, right? Which then equals 612 times 180 equals 110,160. Okay. Now what we do with that is we multiply that by whatever your brokerage is on each leg of the transaction times 2, right? So if you're paying 0.2% brokerage, you're doing that twice. You're going 0.2% in and 0.2% out. So you add the two together, it's 0.4%, right? So you multiply that by 0.004. So multiply that by 0.40%. Okay. I'm going to make that go there. Sure, running out of space here. And that's going to equal so 110,160 times 0.4% equals 440 Rand and 64 cents. So we're going to round that up for the sake of being safe, 441 Rand. Okay, so that is your anticipated brokerage that you're going to be paying on this transaction. Makes sense. So you're paying 200 Rand fee per 100,000 Rand that you trade. That's 0.2%. Okay, you're trading 100,000 Rand twice. So 200 Rand times 2 is 400. Okay, you're not doing 100, you're doing 110,000. 111,000, so 440 is about right. Okay, so you're paying 0.4% both ways of that transaction. So now what you're going to do is you're going to include your 441 Rand fee in your equation, and you're going to take that again out of your risk balance that you're taking, right? So 9,800 minus 441 gives us 9,359 divided by 16 Rand, which now change our number of shares to 584.93. We're going to round down because we're keeping it safe and tidy like that. So 584 Rand, 584 is the total number of shares that we will then be selling in this situation. Okay, so that's like a whole lot of stuff. Are there questions? Does this make sense? Does it make sense to you to include the fees in your calculation when you are working out 2% risk management? It does to me, obviously, but I don't know what you guys feel about it. I'm going to take a sip of coffee, and I'm going to give you some time to answer me, because I believe there's a bit of a delay, actually. What do you guys think of my music? I saw someone send me a private message saying that I enjoy the music. The music comes from I'll show you. The music comes from here. Center screen. Ta-da! The guy's name is Winter Starcraft. He puts up mixes on mixcloud.com, Winter SC, and it's badass. He does one a week. I mean, one a month. It's really cool. It's just like, you know, EDM, electronic dance music. Okay, so it seems there are no questions. It's a bit disappointing, but whatever. Okay, so we're going to go through pros and cons of this again. I'm going to delete this little block because everybody gets it, okay? So you can easily manage risk. So yes, fine. This calculation process is a bit tedious, but you could build this in Excel, okay? I mean, if you don't know how to do the formulas, Google it. Maybe later I could do, I could make spreadsheets, templates and stuff and make it available in the Discord for you guys. That's maybe not a bad idea. So the pro is that it's very easy to use, okay? And there's lots of room for error. So there is, okay, so rands and cents use 1% but don't bother with commissions. Okay, well, fair enough. Whatever floats your boat, whatever works for you is cool. I like to, you know, I don't know, I like to make sure that in those situations, especially with the CFD stuff, I have to compensate for commissions. But anyway, so that's just me. So lots of room for error, so your stops are pretty big, and it helps keep you very objective, right? The cons are your gearing can get very too big. So I'm not really too sure how to explain this. The easiest way to really explain this is to say, if you have, for example, 10 trades that are open, and each one of them are, you know, you use the 2% or the 1% rule, okay? So, okay, let me ask you, rands and cents, how many trades do you have open as a maximum? Do you have a rule that limits the number of trades that you have open? Because you could take, for example, at 1%, let's say you've got 9 or 10 trades open at a time. And whether they're correlated or not, there is a situation where the market can sort of come at you at a bit of an angle, or the market crashes really hard in a couple of days, or whatever the case is. Donald Trump says something, whatever, and all simultaneously or within a day or two, all stop out. Okay, some of them have some slippage, some of them don't. Doesn't matter. The point is, one event basically just wipes you out. You know, you take 20% or a 10% loss across your portfolio in sort of a day or two, simply because you had too many positions open, right? So what happens, and the reason that happens, is because you're not actually thinking of how much risk you're taking simultaneously. And I've seen this happen to people, is they fall into this trap of like, okay, I'm using the 2% rule, I'm using the 1% rule, or whatever the case is, and I should be fine because my risk is contained. And then they just pile on the trades, and they don't necessarily consider what happens in a scenario where all the trades simultaneously bomb out. I'm going to leave you with that thought, because I once again have to go and blow my nose. I'm terribly sorry. The sickness, it got me. So I'm going to play some music for you, and I'll be back. Okay. I did have 16 open today, but a mix of long and short. Okay, so 16 trades. That is, okay, mix of long and short. So your exposure is neutralized, right? So you've got 16 longs and 8 longs, 8 shorts. So it means you have 0 exposure in the market, right? I mean, there's been some horror tales, and I've seen people put on 10 longs and 10 shorts and say, oh, well, we're market neutral. And unfortunately, all those trades simultaneously go wrong, and those accounts just get torn to pieces, right? So you have to think in the sense that, like, it doesn't matter whether you're long or short, no two exposures offset each other. That is just not, I'm going to make this big. No two exposures offset each other ever. If you are long and you are short, you add the exposures. They do not neutralize each other, right? Your margin is on deposit, and you take 10 grand's worth of long, but just trust me, you do not want to be taking more risk than what you should be taking. So, all right, back to sort of this. Remember, the first the rules. Get good. We need to make sure that we study and we get better. The old silent cough, huh? How's that for a ninja move? Okay. So there is such a thing called the exposure rule. So what this says is that, and the basic premise here is that you're not allowed to take, or it's a rule that restricts the amount of risk that you can take in any given moment. Okay, so I'm going to use an example here. J200. Yes, yeah, I'm gonna cough like I'm badass again. I'm gonna make it. I'm gonna survive. Alrighty, okay, where were we? So if you look at the top 40 index, we're going to move to a weekly chart. Goodness, man, hey, you hear that? Ugh. I feel like I'm dying. I don't know what's going on. I just got real sick real quick. Alright, okay. So if you look at the top 40 sort of index here, right? So this is the spot index, not the future. The exposure rule basically tells us that what you want to do is you do not want to be, you don't want to run a lot of exposure to the market or a lot of open risk during times that the market is trading sort of near its highs. Okay. So what happens is, let's say for example you have a long bias, and you use the 2% rule. You put on 16 trades. Most of them are longs. Okay. So most of your risk exposure is towards the long side. But now what happens is the market is trading here at this area here. How do I draw a little box? I want to draw a box. There's too many things, and all I want to draw is a box. Ugh. Okay, well, we'll use this arrow. The market is trading there. Wow. Okay, and you put on, you've got a whole bunch of longs. In this whole period here, you were just longing and longing. These are weekly candles. You were taking a whole bunch of different shares, trades in different shares. You're buying banks, you're buying retailers, you're buying resource companies. Everything was nice, and it's all 2% rule, and everything is great. And you end up sitting with 16 trades open, right? And every single one of those trades risks only 2% of your capital. Now, remember we had a 50,000 Rand portfolio earlier in that example, a little bit earlier. Now, I've said a few times, oh, it's such a small trade, it's only 10 grand. But if you think about it, okay, 10,000 Rand risk or 10,000 Rand exposure on a 50,000 Rand account is 1/5 of the value of the account that you have invested in a particular stock. I'm dying, hey? Wow. This is the most I've spoken all day. I think that's the problem. So, okay, let's keep it realistic. We don't have 16 trades open because Rands and Cents is using the a 1% rule rather than a 2% rule. It's the same thing. Instead of using 2% risk, he's risking only 1%, right? So you now have 8 trades open. So at this point, you are risking 16% of your capital in 8 individual trades, or 16% of your capital in 16 individual trades, whatever the case is. And, that's not too much. It's like a quarter, less than a quarter, is 1/8 of your money. So it's not so bad, right? But what happens is every individual trade, you risk only 2%, but you might have to take 1/5 exposure. So let's say 8 trades, and you're exposing 20% of your cash, or 1/5 of your total cash, you're taking exposure to the market, and you're doing that 8 times. all right? So if you have a 50,000 Rand account and you're exposing, I'm just going to do this, 20%, so that's 10,000 Rand, and you're doing that 8 times, you are running 80,000 Rands worth of risk on a 50,000 Rand account, which means that you are gearing yourself almost twice, right? So we divide that by 50,000, and we're gearing ourselves 1.6 times. So now right here, at the very tippy-toppy of the market, you have more risk exposure to the market than what you have money, okay? So if this thing proceeds to then pummel you, as it did a good old pummeling, I don't know how to make this thing change, as it did a good old pummeling over here, wow, and she pummels, right, all the way down, I'll draw it that way, and she pummels all the way down, you now have more exposure to the market than what you have money in your account, basically. That's the risk, okay? So you get wiped. You lose your 16%. Hell, market slips, you end up losing a lot more, okay? That is obviously the worst case scenario. But what happens a lot of the time is people don't necessarily follow the rules, and they end up taking, 2% or 5% risk, and they end up sitting in 20 trades at a time because, it's not working, and I've got to be patient, I'll just leave that one and this one, and you end up just accumulating tons of trades, and you sit with 3 or 4 times gearing. Or what happens very often, to show you a practical example, I'm just going to quickly, let's just remember, that should remember it. Let's use a practical example. Give me a stock, any stock. Man flu, yeah. Open orders, of course, can also be risky for any type of event, yeah. Okay. But okay. So let's say MTN, right? I'm just picking stocks off the top of my head. You want to go long here because, I don't know, that's what you want to do. And you want to trade a 1 hour chart. And you're like, okay, cool. I'm going to put my stop loss here. I'm going to put my target here. I want to take this trade. So there's my entry. That's my stop. That's about right. And my target is this gap close, right? And that's like a cool trade. And I'm going to take that. And what I'm risking here is 0.7 for 1.6. So that's like about a 1 to 3 risk reward. So that's cool. Or 1 to 2 and a bit, right? So that's cool. That's like a trade. So I'm going to work out here. What's my entry price? My entry price is going to be anything below 85.20, and my so we're going to write 85.20, and my stop loss is going to be below 84.50, and my target price is 86.56, right? So now what I want to do is, because I have 50,000 Rand in my account, I want to lose only 2%. Which is going to work out to $1,000 if we remember correctly. So left screen, I'm going to go back to, you know what? I just figured it out. This is going to be our working pad. Get good. So we only want to risk 1,000 Rand risk, right? For the sake of easiness, we're going to ignore the fee calculation because this is going to take too long. So we're going to risk $1,000, and we are entry is here at 85.20. Stop is 84.50. Stop equals 84.50. So that means our risk is equal to 85.20 minus 84.50. I'm just going to work it out because I'm lazy. 85.20 8520 minus 8450. So we are risking 70 cents, right? Risk is equal to 70 cents, and we want to risk 1,000 Rand, right? So Rand 1,000 divided by 70 cents, right? Equals how many shares we have to take. All right, so 1,000 divided by 0.7, we can take 1,428 shares. Yeah, okay, because if we get it wrong, if 1,428 shares move from, that distance, it's not so bad. What we don't realize we're doing is we're taking 1,428 multiplied by 85 Rand 20, right? I'm going to do that to make it sink in a little bit. So 1428 times 85.20, and we're taking 121,665 Rand worth of risk. Okay, 121,665 Rands worth of risk. Remember, we have 50 grand in this account. Let that sink in. Okay, you are taking so much more risk. Let's divide that by 50,000, right? You are taking 2.4 times as much risk as you have money. Cool. Now, let's do that on 5 or 6 different open trades at a time. And suddenly you realize that what you're doing is you're taking a colossal risk right at the point where we're going to go back to our J200, right at the point where the market is trading at its sort of tippy top. So we're just going to, for the sake of example, where the market is trading close to the highs. Okay. So does that seem logical to you? When the market is trading at its highs, for you to take 2.5 times risk of all your capital in one trade and then do that multiple times? It's illogical. Okay, it is dangerous. Is what it is. I'm just going to check for questions. Okay, no. All right. So, what our exposure rule now tells us, basically, is that we can't take more than a certain amount of gearing in certain phases of the market. Okay, so I'm going to switch this chart back to a daily. I got that song in my head now. I actually want to play music in the background, but whatever. So we're going to switch this back to a daily. Okay, now remember, this is our sort of high, so we're going to not, we're just going to ignore that. We're going to delete it. So what we're going to do here is we're going to measure the market in percentage terms. Okay, we're going to set up like blocks, 5% blocks. Okay, boom. And these are approximate. Okay, I mean, you don't have to like do them absolutely perfectly, but if you want to be really meticulous, you can. So you just kind of set up like these 5% blocks on the market. And there's like real logic to why you would do that. So you see what I'm doing here? Every 5% that the market comes down from the highs, I'm just marking it off. Put it over there. And I'm measuring 5% from one level to the next. So it's not 5%, so obviously it's not logarithmic. Oh my goodness, I've lost it. 5%, 5%, and we're gonna do one more. The man flu. Man, I tell you, I was visiting with my sister and her kids, and I'm telling you, those little kitty bastards, they're the reason I'm sick. But okay, so every one of these blocks that we have in here now is 5% lower from the high. Okay, so what our rule tells us that we can do is, in this block we can do one times gearing. I'm not going to put in caps locks. Let's make it red because red is sexy. No, it's not, but whatever. 1 times gearing. So if the market is trading between these two levels from the high, you measure from the high down 5%. In that first 5% down, you are allowed to take as much risk as you have money in your account. Okay? So what this means is you might have to adjust the way that you trade. The 2% rule might not work for you because now in a situation where you want to take a trade, the 2% rule hoys you 2.5 times gearing in one trade. Okay? You can't do that. You can't be long 2.5 times more than you have money, because the risk is that the market falls really hard. The market falls 10%, and you need 5%. You need basically, anyway, whatever. The point is, it's a ton of risk. Okay? And you can't necessarily afford that risk. So if the market falls 100% and you are 1 times geared, you're going to lose all your money. Okay? If the market falls 50% and you're 2 times geared, you're going to lose all your money. If you're 3 times geared, the market needs to fall, 30% for you to lose all your money, 33%. If you're 4 times geared, it needs to fall 25%. The more gearing you take, the smaller the movement the market has to make in order for it to completely wipe out your trading account. Okay? So your entire goal is to prevent that from happening. So what you say here is that each trade has a percentage exposure versus capital. So let's say 20% or 25%. So if I take a trade in MTN, is the stock that we were trading. If I take a trade in MTN and I've got 50,000 Rand, I can take a maximum of 10,000 Rand exposure to MTN per individual trade. Okay, so this means I can have 5 trades on. So I can trade MTN for 10 grand. I can trade BTI for 10 grand. I can trade, I don't know, whatever, 3 other stocks, Firstrand. I can take some Anglos, whatever, but I can only take 10,000 rands worth of exposure while the market is at the first 5% increment of the from the high. If it comes down, let me learn how this works. If it comes down into the next 5 to 10% block, I can now take 2 times gearing. All right, and if it comes down into the next block, I can now take 3 times gearing, and so on, and so on and so forth. Right. So what this is doing is it's allowing me to gear up the deeper the market falls. So if the market comes all the way down here, you see, if you were buying in this area here, for example, and you're now 5 times exposed. So here the market is already down 5, 10, 15, 20, 25% from the high. The market doesn't fall 25% very often, okay? And sometimes, hey, it does, okay? 2009, 2003, 1987 is all crash scenarios. So all of them were more than 25% down, okay? Not all of them were more than 50% down. In fact, none of them were. I don't know about 2000, it may have been. But basically, what you want to do is you want to say that if the market has fallen 25%, I'm willing to risk 5 times as much money as what I have, because the probability of a market bounce from here is pretty high, right? So if the market falls deeper and deeper and deeper, I can take on more and more gearing, because if the market then bounces from that point and goes back to a new high, I've got 5 times as much exposure as I have money, then I make real money on the way up, right? If it doesn't happen, then I'm not overexposing myself to risk. So this is a much longer term mindset, I think, to have when doing this. So going back to our sort of rule here, we can say that every trade has a set percentage of exposure versus capital, 20 or 25%. If we're on 20%, we are allowed to take a maximum of 5 positions. Maximum of gearing 1 per position. So if I'm trading MTN, I could potentially take, no. Go away. I can potentially take 5 entries into MTN. Okay, so if I get it wrong, I can buy it 5 times. I'm going to open an MTN chart just for interest's sake. Is this making any sense to you guys? I mean, let's just find out if it's making any sense to you guys. Okay, with all the land runners in JSC, I will not risk more than 1% trade and max 5% in all open trades combined. Okay. At the moment, 12 trades, total value 2.1 times account worth. What about stop losses have been moved to break even? Yeah, okay. What if stop losses have been moved to break even? That's a good question. That is a good question. I know that some trading service providers would even free up margin for you if you do that. To me, it doesn't count. I don't think it counts. And every now and then on Twitter, I'm like, hey, this stop has moved, this entry's moved to stop, or the stop's moved to entry, so it's now risk-free. But there's no such thing as true risk-free, right? It can slip through your stop. So I would say no. I would say rather err on the side of caution and conservativeness, and don't, and rather not. Yeah. Okay. I think it depends on what time frame you work on. Longer. Okay, true that. 12 trades open. Okay, cool. So back to our example. I'm getting real good at this over there. Okay, so we can have maximum of gearing 1 per position. So what happens here is, let's say for example you are trying to buy MTN, okay, and you want to buy, you using just a simple sort of trend line break, and you break that trend line, and it breaks that trend line, which is like really sharp, and you buy, and you don't take your profits, and you may have another trend line here, and there you buy again, and you don't like get a chance to get out, and it gains down. Okay, this is maybe a terrible example, but the point is, if you take 20% exposure in this trade, and 20% exposure in this trade, and 20% exposure in this trade, let's use the Aussie because it's not, MTN's not a good idea. So if you use 20% of your exposure to go long in this block, okay, by the time it's come down 5%, you would have lost, let's just see here, 20 times 0.05, 1% portfolio, okay. If it then falls another 5%, you now in for 2% of your portfolio. So if you now increase the gearing here, if you take another position, then yes, your risk is going up. But you're basically, you can get to a situation where you can kind of get your way out of trouble, right? So you can add to a position 5 times. Now, obviously, you shouldn't be adding to losing trades, okay? So, but you can say, for example, okay, if I buy this thing and it breaks out, I'm going to buy some more. Anglo is a good example. Buy some at 341. If it goes up to 350, I'm going to buy more. If it goes up, I'm going to buy more. And then you can go up to a maximum of 5 positions in one stock, okay? But then you can't have positions in other stocks. You can only have positions in one stock, because if the market is at or near its highs, you can only trade 1 times on your capital, okay? If the markets come down between 5 and 10%, you can go 2 times gearing. Between 10 and 15%, 3 times gearing. Between 15 and 20%, 4 times gearing. Okay, so as the market comes deeper down, you can take more risk. Okay, so now the example that I actually have here is different, which is a bit more accurate again, actually. So what you want to do is, and this is kind of based on the fact that if you are long and you don't stop out, okay, and you add every step of the way, so you have 1 times exposure. Remember, it's a CFD account, right? So there's gearing involved. So if you have 1 times gearing and it comes down 5%, you've lost 5% of your money. Then if you double up and you take 2 times gearing and it comes down another 5%, then you've lost more money. And it works out to, if the market comes down 50%, you would have lost obviously a huge amount of cash in the process, but you'd still be long, you'd still have a position, and you would be 5 times geared. Okay, so your increments here are 5 between the all-time high and 5%, between 5% and 10%, between 10% and 20%, between 20% and 35%. See how these increments are getting bigger? That's a 10% gap, right? So only once it hits 20% down can you put on your 3rd layer of gearing, okay? Between 20 and 35, another 15% it's got to drop. 35% down, you can put on your 4th layer of gearing. And between 35 and 50%, you can put in your 5th layer of gearing. Now 50%, even during the Great Depression, is like only the Great Depression was more than 50% down. So if you are in a situation where you're trading index futures, for example, and you're just that kind of guy that can't stop out, because then you trade, okay, and as the market comes deeper, you increase the gearing, but you make sure that you never take more risk than you have money. Not in the top 5%. And as the market comes down, you can know that you can sustain a drawdown in the market of 50%, or in the instrument of 50% against you. So this can work on the Aussie, it can work on an individual stock, it can work on whatever. You can sustain a drawdown of 50% against you. You will not have lost all your money, and you will have 5 times gearing. So if that thing then bounces back up to the high, you'll make a fortune, right? It is a very sort of fund managery way of thinking about it. Okay, so I don't know. I'd love to hear what you guys think about this. The con here is obviously that you, if you're doing this on a single stock, for example, like MTN or ShopRite or whatever, and you do hit 50% down, and it does go deeper than 50%, it goes down 60%, you are wiped. It does a phenomenal amount of damage to your portfolio. Okay. But the pro is that the probability of that happening, not from an individual stock perspective, but from a broader market perspective, is very low. Okay, so if I apply this rule to the top 40 index, and I say if the top 40 index is in the first 5%, I will not gear more than once the money that I have in my account. And I'm trading single stocks, I'm trading MTN, I'm trading Anglos, I'm trading whatever, but I'm not gearing more, I'm not taking more risk than what I have money. And yeah, you know what, fine, I have to churn it out. I've got to make up 0.5% here and 1% there, and take lots of little trades and make $1,000 and make $200 and make $300 and make $2,000, and every now and then you hit the luck and you make big money. Okay, the intraday trading accounts is obviously there's gearing involved there, but on CFD stuff, it's a bit different. So, and you grind it out. You have to grind out tons and tons of trades in order to make money. If the market comes down 2%, or where we are now, we're in the 3 times gearing mode. Okay, so if my bias here is long or short, it doesn't matter. I know in this phase of the market I can trade 3 times gearing, because the probability of the market going down another 50% from here is a lot lower than what it is the probability of the market going up. So to adjust these lines that I have here, so that would be 5%. Our next level is between 5 and 10%, so that's correct. Our next level then is between 10 and 20%. So this line actually has to move there, right? So this is my 3 times gearing block. That becomes my 4 times gearing block. And then we have from 20 to 35%. So we've got to measure 15% from here. 15%. To the A-team soundtrack. Alright, so that's about there. That's my 4 times gearing zone. And then we can zoom out even more. And we have to then put 5 times. We have to then whatever, you get the point. Actually, you know what? I'll do this exercise. It is terribly boring, but I'm going to do it from scratch because it's important to make the example. And also gives you guys time to come up with questions if you have any. Oh wow, you're not even watching me do this. Wrong screen. Ah, psych! So I'm going to switch that to there. Okay, so I'll do this exercise. So we're going to start at the top here, right? That's our high. And we're going to say the first 5%. We're allowed to take 1 times gearing, right? So there's our first 5%. And we're going to put the line over there, bang. And we take 1 times gearing in that portion of the market, okay? From there, we're now going to measure between 5 and 10%. Okay, so 5%, another 5% down, puts us roughly there. Okay, doesn't have to be exact because it is for the sake of example. All right, the next measure is a 10% jump. So now we're going to have to move from here 10%. Da, 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 da. Down to about there. So in that area, we'll take 2 times gearing. In this area, we're going to take a maximum of 3 times gearing. Then we're going to do another 15% down from here, which is there. And that is our 4 times gearing zone. And from there, we're going to do another 15%. And that's our 5 times gearing zone. So in theory, what we can do here is sustain. Oh, that's only 40%. We got to go another 10. So in theory, what we can do here is sustain one colossal drawdown without having to be out of the game. Okay, if that makes any sense whatsoever. Dun, dun, dun. Questions, guys? I'll add to my winners and move stop loss to still be 1% or less. Don't add to losers. Been there, done that. Okay, yeah, good man. Good man. Okay, so pros and cons. Once again, I'm just going to sort of finish with this. Still have to use high probability levels to enter. Okay, that's part of the rule. Add to trend line, blah blah. So work out the gearing. So 20% exposure is usually 2% of the capital in your account as margin, right? So so the pros here is it prevents you from being blindsided by the market and taking multiple 2% losses in a row. So it keeps you your gearing and your exposure down. So it's a bit more like conservative on the one side, and it keeps you mindful on the amount of risk you're taking, and it sort of slows down the volatility of your return. Okay, because your return profile is a bit smaller because you're taking less risk. The con is that you have variable sizes of losses in percentage of capital. So if you eventually stop out or whatever, you can. So you see that, yeah, I've stated that there's. I'm pointing at my screen. That there's a 12.5% max capital risk in the back testing that I've done on the system. Okay, so that's quite a bit, right? So if you stop out of one trade, so if you use this like these brackets and you buy MTN and it falls 5%, you buy more and it falls and buy more and falls, and every time you buy the same amount of exposure, by the time you stop out, you lose 12.5% of your capital in one trade, which is huge. Okay. Obviously, what this does is it reduces the probability of you being stopped out, but it increases the loss that you take when you stop out. So the return profile that your account gets is a lot smoother, but it has like these deep drawdowns. Okay, and this is where stuff like hedging strategies and stuff comes into play. But this is more something that if you were to manage like a medium term sort of, I don't know, it's a nice way of trading. I don't know if you guys, I don't know if I'm bringing this across right. I hope so. If there are questions around this, please let me know. Okay, question. Do you always wait for price action to confirm and enter on the fly, or do you have orders placed? So I actually like to enter trades like manually. You know, I like to be like, okay, click, I'm in. Although I have a new fancy schmancy platform that can do like contingent orders, so I'll probably start using that. So the contingent orders basically say that if you know, what you could do is, like you say, if the bid price is above 340, buy X amount of shares, limit price 340.50 or 341.50. Those types of contingent orders you can use, which is pretty cool. Alternatively, I would like wait for the closing price and then enter it manually the next day, be in the opening auction, or be in the first hour of the day, or whatever the case is if I'm trading a daily time frame. So the idea is to wait for the candle to close, that is your signal, or you wait for your signal to confirm it, that only does that when the time frame that you're watching has closed, right? So if it's a 1 hour chart, the candle must close, and the next candle you can trade, and then you just take it whatever price in the next candle. If you're trading daily, the slippage, if it's depending on the stock, but the 0.5% here or there is not the biggest issue in the whole world. And if you're trading, for a couple of days, whatever, and if it's 1 hour charts, 50 cents up or down on a 200 Rand share, is a lot, but it's not necessarily like the worst, especially if you're trying to take like 10 Rand, So you wait for the thing to close, and then I try to get in manually, usually either in the opening or closing auctions, or, just sort of wait for the market to open and then wait for that big huge spread to close, and then you enter your CFD position, or sometimes even over lunchtime, wait for the market to get real quiet, and then you put your CFD positions on and off in that period, because the market prices start to sort of stabilize and there's not really a hell of a lot going on, which is quite a nice time to do it. So I don't just do it on the fly. You have to wait for confirmation, but I don't have like orders either just lying in the market. I do have stop loss and take profit orders lying in the market, but I don't have entry orders lying in the market. I don't know, maybe that'll change. It might be a personal preference thing. So okay, cool. So Fib retracements was the question that was asked right at the beginning by Smart Money Institution. I think Smart Money, what we're going to do is we're going to talk about that next week, because I don't think that there's going to be enough time. We've been going a little bit long, so I don't necessarily want to. I don't think we're going to be able to do that this evening. Okay. Are there any questions around this thing? Now, I would have liked to see you guys do some of those charts. So if there are any of you that want to join the Discord, it should be in the link below. If you haven't joined the Discord, join up. Advil works, yeah. So if you want to put up some charts, I'd like to see what you guys are looking at. That'll be really cool. And we can see if there is any kind of, let's keep this interactive, man. I'd like for you guys to do like the exercise, basically, is really what I want to do. Last week, we spoke about the 3 different types of trades. Oh, yes. Where do you put your stop losses? That was the question. So, okay, fine. We're going to go over time. It does not matter. So where do you put your stop losses? If you look at, and this is actually kind of, you guys have to give me like stocks you want to look at or trades you want to do, and then I'll weigh in. It's important to know that my way isn't the only way, and it doesn't necessarily mean that I'm right, but it is an opinion, and I can share it with you freely. It's not too much of a issue. So let's do that. I just want to put these things so that I can see all the things. Okay, so some of the things that I've been looking at. So one of the things I said it on Vince Lane last night was to go long Standard Bank and to go short Firstrand. So let's emulate these trades if we were to take them, right? If we were to take a long in Standard Bank here, where would we put our stop? So first we need to look for what are the reasons we want to be long here. So I did a thing, I think I put it on the Discord for you guys. Let me just check here actually. In the research tab, yes I did. There's a little thing there that says, looking at the J212, I think it's the J212. Yeah, J212, which is the FINI 15 index, right? And for the sake of ease, I'm just going to open it here. Right. So, click on it. it has now downloaded. Oh, there we go. Downloads. J212. Where's it going to open? There we go. All right. So this is like a thing that I did. So what I did is I looked here at the Financial 15 index versus the top 40. So this is the index price chart, and this is a relative strength comparative versus the top 40. And we can see that the for some time now, the index itself has been outperforming the top 40 index. You can see here that it's trading. So basically what this is relative strength comparative with the 89 moving average on. And then if it trades above, it's outperforming. If it's trading below, it's underperforming, right? So it's like an easy sort of visual way of looking at it. Then within the index, I looked at certain things. So Standard Bank is outperforming. So now I'm looking at the individual stock versus the index, right? So we know the index is outperforming the top 40, so it's an outperforming index, and we're looking now at the individual stock versus that index, right? So Standard Bank is outperforming the index, and that index is outperforming the top 40. So that means Standard Bank is one of the top performers, and it's been quite recent here that it's been doing that. Okay, so it's just this like last little pump that it's had here. So that's Standard Bank. It's one of the outperformers, right? And then Firstrand we saw as one of the underperformers. So it's been underperforming some time. It sort of came back in line and is failing and is underperforming a little bit. ABG, African Bank. Absa Group is pumping. I mean, it's far outperforming the index, and we saw on Tuesday it ran really hard as well. Sanlam outperforming. Nedbank is sort of outperforming still a little bit. Old Mutual, there's not really enough data. RMH is in line with the index. Growthpoint is underperforming to in line. Capitec is outperforming to in line. Discovery underperforming to in line. Redefine underperforming. Investec is underperforming by quite a margin. NRP, Nepi Rockcastle, is underperforming. PSG in line to outperforming. INL underperforming, which is Investec again. And RNI is underperforming as well. Okay, you're short DSY and short Kumba. All right, let's look at Kumba. Yeah, thank you, Heinrich. Okay, so anyway, so that's why I was looking at longing Standard Bank and shorting Firstrand, because Standard Bank was an outperformer and Firstrand was an underperformer. So for the sake of example, I'm just going to finish this. So let's look at this. All right. So the first thing that stands out, so using our trend thing, we're going to go back and we're going to look at about 3 years of price data to determine what our trend is. Okay. And if I look at approximately 3 years worth of price data, so 2004 kind of starts here, so 2005 here, we can see that over that period the trend is up. The price starts here and the price is now here. That is up. Means the trend is up, right? So what we want to do is we want to now enter into so we know we've got a primary trend that is up, secondary trend that is down. It seems that secondary trend has now ended, and we may be in a space where we're seeing a continuation of the primary trend. Okay. So we're going to draw in this trend line to see whether or not we have a sort of confirmation that we're now starting a new trend. Here it seems that we have a retest and a break and a retest, and eventually we break this trend line. It's not the sexiest drawing in the whole world. I'm not going to be like too specific, but I mean that's close enough, right? So this is potentially a trend change in this situation. So we might want to be, we want to be long for this thing, and we've now decided that this is what we want long. It's the one. So we are happy to buy it sort of here, right? Or we wanted to buy a breakout of this resistance level. So you might have ended up buying there. If you were a little patient, you could buy it like tomorrow if you wanted to. I don't know what the US is doing. I'll have to look a bit later. Actually, let's have a look. Because we might not want to buy it depending on what is happening in the United States. Okay, US is up. Rand is stronger. Alright, so everything is still in place. We are still somewhat bullish on the market and the banks. So we want to be looking for longs. Okay, so we might even buy it here. So where do we put our stop loss? So rule of thumb is that you want to put your stop loss one low or two lows ago. So we're basically following now the tertiary trend, because remember, this is our secondary trend, and inside that secondary trend there's these tertiary trends that we see the market doing, right? So these are all our I'm just going to draw a couple of lines in here. Let's make them let's make a pink. I love me some pink. It's my favorite color. And we're gonna put more. So here we have like tertiary trend lines. They're not gonna be perfect, so cut me some slack. So these are like our tertiary trend lines within the primary, within the secondary trend, which is a correction wave of the primary trend, right? And I'm not going to draw them all, but you could see the basic sort of waves that it's making here, right? So what you want to do is you want to identify significant levels. The first one that stands out is going to be this level here. Pow. You might not even want to draw it as a line. What you could draw it as a box. Now I haven't figured out how to draw bloody boxes on this platform yet. How do I draw a box, man? I just want to draw a box. Goodness. Whatever, okay. That looks like a box. So there appears to be a resistance / support level, okay? So if we take a long position here, the logical place to put your stop loss would be under this low, because what we're doing is we're trading this trend. We're trading this trend, okay? Ay, 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 ay. Da, 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 da. I should play music while doing this. The silence gets a bit hectic. Okay, and we don't know how far this thing goes up, obviously, but we're hoping it goes to the moon. This is Standard Bank, yeah. Daily, yes, daily. Standard Bank, Daily Bank. Standard Bank Daily, Christu, and hello, Yaku. Okay, so what we're looking at here is this is now potentially, so we've got this little counter trend movement. So we've got remember, if we zoom out, we are primary trending it up. Oh, I hit the microphone. Primary trending it up, secondary trending it down here, which now seems to have broken and continuation of the primary trend. And inside this, we have these tertiary trends, which is our sexy pink lines, because pink is sexy and amazing. So from here, we want to put our stop loss below a previous low or a significant support resistance level. So now there's two ways that you can play this. There's a conservative way and there's an aggressive way. Okay, the conservative way would say, instead of using the most recent low that the price has made, I want to use two lows ago. Okay, so instead of using so two significant lows ago. So the most recent significant low is this level here. Okay, two lows ago is this level here. Okay, you see that? Let's make it bigger. Wait, no. Make it bigger. Make the line bigger. Alright, and we're gonna gooi this one also like a duck. Like a duck gesmeer, bro. Okay, so you see that. So there's two different ways of doing this. The aggressive way, is to put your stop loss here. And you're not going to put it like, so if you read this thing and you see, okay, the low of this candle, which is indicated the high-low close in this area here. So if I put my cursor over the candle, which has the lowest point in this thing, which is this candle here. I can see the low here is 182 Rand 28 cents. So I'm not going to put my stop at 182 Rand 28 cents. I'm going to put my stop loss at 181 Rand 90. In fact, maybe even a bit lower, maybe 181 Rand 82. Okay, because what's going to happen is if they test the support level, remember it's a zone, but if they test the support level, they're going to push it through the level to see how many stop losses they can collect. Because the big fund managers, that's just, you've ever been stop hunted or heard of that? Yeah, it's a thing. It happens. They know that all the oaks are sitting there. Their stop loss is at 182, and the rule on the platform says if it trades below 182, stop me out. So what are they going to do? They're going to push it through 182, and they're going to see all those market orders coming in, all the stop losses, and the big fund managers are going to sit and scoop up your stock sub 182, and then they'll push the price higher. Okay? So I'm going to do a random, never a round number, like a random number, 181 and 82, 181 and 79, or just some random number that's around that area, okay? And obviously I'm going to work out my risk and stuff based on that number. So below that first significant low is very aggressive. The highest probability of stopping out, but because your stop loss is so tight, because your entry now is, let's say, below 194, okay, for the sake of giving this thing like an actual chance to get filled, because it might open higher tomorrow, and then if it opens higher, we might not get, so whatever. So we're going to say we are willing to enter at 194, and we will we'll enter anywhere below that. So our stop loss is here, our entry is there, so we are going to use, let's use our get good. We're going to sort of keep our same parameters actually. So our entry is going to be 194. Our stop loss is going to be 181.81 for the sake of it being random. Our risk here is 13 Rand and 19 cents. Let's just be sure. 19400 minus 18181. 12 Rand and 19 cents. You see, that's why they made calculators. All right, and that is 12 Rand and 19 cents. I'm going to change screen so you can see what I'm doing. So we're going to risk 1,000 Rand on this trade. 1,000 Rand divided by 12.19. We're going to take a whole whopping 82 shares, which is going to be 82 times 194. I got the 18 song in my head, and I don't know why. 82 times 194. 82 times 194. So we're taking 15908.00, and that divided by 51,000 or 50,000 equals 0.32 rounded up risk. Okay, so we're taking 30% exposure. So okay, does it? So, but this is based on 2% rule. Okay, so back to our thing. So we can take 82 shares long here if we want to risk $1,000 in this trade. We can take 82 shares long, and we stop loss there, and that's a fairly aggressive trade. Okay. So now compare that to stopping out at 165.65, because in this situation, I'm going to zoom in here. In this situation, right, I'm putting my stop loss level below this candle's wick low. Okay, so I'm going to zoom in here so you can see this thing. There's the wick, sorry, not wick, tail. The wick at the top of the candle and the tail at the bottom of the candle. Okay, that's those lines, right? So instead of using the body close for the level that I'm going to put my stop loss, I'm going to use the tail close. Okay, so not the tail close, but the tail as the extreme of that candle, and I'm going to go below that extreme. Okay, so I'll maybe put my stop loss here. I mean, for the sake of it also being a totally random number, we're going to put it at 165 Rand and 53 cents. Okay, So now if we zoom out and we look at this thing, we have a huge stop loss. Okay, we have an absolutely huge stop loss because now our entry is still 194. Okay, but our stop loss is now 165.53. Okay, so we are suddenly risking, like in rand terms, a lot more. So 194 minus 165.63, 28 rand and 37 cents, right? So 28.37. So 1,000 divided by 28.37 gives us 35 shares. 35 times 194 gives us only 6,790 rand worth of shares. Okay, which is divided by 50,000, only 13.5% exposure of capital. Okay, that's a much safer trade. So it depends on how risky you want to play it, where you put your stop, whether it is at the first significant low or at the second significant low. Okay, alternatively, what you want to do is you want to identify a significant support and resistance level, and you want to put your stop there. So I'm going to now look at okay, short DSY. So we'll quickly just have a look at that. DSY. Oh, okay. So you would put your stop either here, right, or here. I'll draw them in. Either there or there, right? If you want to be short that. This is maybe a very nice trade. Hey, well done. And ironically, DSY, as we saw, is one of the underperforming shares in the index. So good job. Oh, looking at the wrong damn screen again. You should tell me when I do this, guys. So first stop. So stop there, which is your first significant high. I don't know where you got into this trade, or there, right? If you got into this trade if we do that, okay, and we say that we went short it here, then your first stop would be this one. That would be your stop loss. And then you'd say your second significant low, or high in this case because you're short, would be there, and you want to actually kind of put it above that wick because you want to compensate for any kind of freaky business. Now there's a ton of debate whether or not to use the wicks or the real bodies or whatever. I use the wicks because it's managed to trade there and didn't commit to that, so it might be able to do it again, you know, especially for stop losses where stop hunting is like a real thing. You know, take profits, for example, is you got to be a bit more precise, I reckon. But with stop losses, you got to give it room, man, because the guys, the big funds, they'll push the stock around and they know that they're going to take the little guy's money, which is all of us. So we want to make sure that we don't fall prey to them. And then let's quickly look at Kumba. So just to go back here, does that make sense? That I'm saying like, okay, I see my internet's slow. I can't wait for my proper internet. It's still not back. So I'm using Vodafone mobile data. Anyway, Vodacom. So, you know, obviously if you entered into this, that would be your previous significant high. And that would be the second, or, you know, 2 ago. And if you entered before this turnaround, that would be the reason. Okay. All right, it doesn't seem that there are any questions. Where is the Discord? Ain't nobody saying nothing. Yeah, you can use this Discord, guys. It's really cool. Anyway, okay. It's back. It's back. It's back. It's back. It's back. Sorry about that. As I was complaining about the interwebs, it seems that I dropped and came back. But okay, so Immediately, I'd say that would be the low, just looking at it. But I'm going to take that away for now, and then we do the whole sort of process again, right? We're going to look at sort of 5 years worth of data. Go away. And look at 5 years worth of data. Yeah, see, my poor computer is struggling, eh? The internet is too slow. 5 years worth of data, the trend, my friends, is down over 5 years. So this is a bit confusing because, is it down? We'll have to look at more. Okay, so we could have a situation where we've now had a long downturn, and this is like a real proper turnaround, okay? And we've had a situation like that or a situation like this, and we have a continued run, and it should go up to make new highs. So for the sake of simplicity, we can say, remember, our primary trend lasts anything from less than a year to decades. Secondary trend from a couple of days to 3 months, and tertiary trend from a couple of hours to weeks, right? Sorry, I'm getting phone calls from people. So what we're going to do is we're going to say that we're going to put in a low here. We're going to say that we have a significant trend change situation here because we have a big old trend line. Big old trend line that broke. Okay, so that is a significant trend change situation. And we're going to say from here, from 2006, our primary trend is now up. Okay. Okay, so that was Standard Bank. Okay. What are you talking about, your rands and cents? Are you talking about Standard Bank stop losses at 164? Or are you talking about Kumba stop losses at 164? Or Discovery? Yeah, just let me know what you're talking about. In any case, okay, so now we're going to switch into a daily. And we're going to go for roughly 3 years worth of data. It should remember where our trend line is, and that'll be our marker. Okay, so there we can say the trend is pretty much up, right? We've had a significant resistance level here and a close above it, so that's maybe a long trigger, right? So well spotted. I mean, Monday there was game here in this thing. I was actually a bit upset with the guys, and if you're watching any of this, Yaku, Pamela, I'm actually a bit upset with you because on Monday I was like, listen, these Kumbas are the ones to watch because Iron Ore did this and Vale did that and blah blah blah, and nobody bought any. Eh? Anyway, so the trend is up, and we have a resistance, a significant level here by the look of things. One time significant level here, and we can make it a box because remember it's not necessarily a pure trend line, but if we want to be really truly meticulous with that trend line, it would probably be there. And the reason I say it's there is because if you look, it's got real body closes underneath it here, right? It's very close to real body closes there. We've got this sort of relationship with it can't, so there's real body closes on it there. There's real body closes on it there. There's real body closes here, closes and opens, and same here, right? So that is kind of like if you were going to really put a trend line in there, that would be probably the place to put it. So you could say that we're going to use Dow theory here. We have had lower lows, right? And lower highs. These are the same. So now it's making a new high. Now it needs to come back down and make a higher low than this one, and then do that again. And then the trend has gone from primary up, secondary down. Primary needs to continue up, right? We need to change the primary trend to long. Oh, DSY. Okay, cool. Oh, all right. Let's quickly look at that DSY then. So I had a whole bunch of lines drawn in here. Internet is so slow. All right, and 164. Okay, all right. So it's that first level. Okay, cool. So that's the riskier way. So there's always a risky way and a conservative way. And you've gone for the riskier way. And the riskier way, obviously, you take bigger positions and you need smaller moves to make more money, and it's wonderful and great and stuff. But it depends on your time horizon also. If you're a more active trader, very short term, only want to be in a trade for a couple of days, then obviously you'll take the riskier plays. If you don't mind sitting in a trade for a couple of weeks, then you take the less risky trades. So in any case, so what we need is we need this primary trend to continue up now. We've had a secondary trend down. Primary trend is up, secondary trend down. And we've now we're maybe in a situation where we have a primary trend continuation up, right? So we're looking for longs. So straight up, if we take a long entry here, where is our first significant low? And that is right over there. That is right over there. 243 Rand. So 242.79 is maybe the right, maybe it's random enough to be right. So let's just see what the low was on that candle. The low on that candle was 244.14. So 242.79 is giving it a little bit of slippage, so that's maybe not a bad level to put a stop loss. So you'll notice there's always like some random number, right? Another significant level appears to be this, right? You can see here, if you look back, if you look back, that was resistance there for a while. It broke out and it proved to be a bit of support. And then here it touched 1, 2, it kept bouncing off, touched, bounced off, sort of came close. I had a bit of a fight here, broke down through this level, probably sucked in a ton of bears because that was like, you know, looking, man, trading a range down into a range, breaks that range out, boom, fake breaks out, and, you know, sucks in all the bears and bloop, back in. So this, maybe what we should do is consider this as the potential of a fake breakout. So I would say maybe there's not even a long entry here yet. Maybe what we need to do is wait for a breakout, a retest, a confirmation of that retest, aka we want a consolidation on the level, right? So we want to see like a consolidation like this, for example. Let's go back and look at a previous example where there is potentially a range-based breakout. Yeah, you see, I'll just do that. Okay, because that is a bit of a level 2. Okay, so we want to maybe see a break and a pullback and a confirmation, or some sort of a proper consolidation. So here, did we have, see, there's no consolidation here under this level before it breaks out. So for me, it doesn't feel like it's a big significant level that took a while and there was a seller and it took a couple of days or a couple of weeks and the oaks just kept buying, and eventually the big seller is out of the way and boom, the continuous market pressure can push the stock higher. This feels like, and we know also that this was based on like news, but it's like just this rip. And it feels like perhaps it was a low volume move. So let's look at volume. We are going to add an indicator and we're going to add volume. Volume. Okay, no. Looking at that, that is a high volume breakout. Eh? That is looking good. Looking good. So, all right. So, ideally, if you had to enter into this trade immediately because you feel that this is it, like it's going, it's now or never, you might want to take a very conservative approach in terms of your position sizing. So I would either stop here at this 260 level. I think 260, we've seen in the past, they've stop hunted guys here under this level. So maybe 242 is the safer level. Yeah, that would be my play. Alternatively, if you wanted to be really very aggressive, you would put your stop loss just below 320, right? So you could stop here at like say 317. That would be like your hyper aggressive stop loss. at 317. The reason for that is this is a significant level. This 320, whatever level it is, make it thick, and let's change the color to nice dark blue. This is a significant resistance level that it had broken. We can see that it tested here once, twice, 3 times, 4th time it's broken through. Okay. Similarly, they've stop hunted. It's been a channel that has been trading. It is a high volume breakout of this channel. If you look here, this was also on high volume. Hey, so this may have looked very convincing at the time. So if you do get sucked in here, you put a very tight stop on here. You don't want to be long this whole thing and it comes all the way down. So you've got to decide. If you put your stop at 317-ish, right, which is kind of giving it, what, $5 under that significant level breathing room, that would be a very aggressive approach, and you would lose the same amount of money as if you put your stop all the way down at 242, 243. Okay, so it really depends on how aggressive you want to play it, I guess. I don't know if I've answered your thing, but yeah. So obviously, if you put your stop here at the top, you're going to make a lot more money because you're going to have a much bigger position if this thing goes back to 420 or 410 or whatever it is. If you put your stop down here, you might wish you bought more. But you can always add into positions on pullbacks and stuff like that. So it really depends on you. But those would be the 2 ways I would play it. One aggressive, one conservative, and you pick which one is best for you. Anything else, guys? Anything else? We've been going for almost 2 hours, which is a long time. So I don't want to keep you guys for too much longer. I'm happy to sit around for another 15 or 10 minutes and look at some of your charts. Let's see if you have any stuff in the Discord. Use the Discord, man. The Discord is going to be awesome. We can also chat during the day. I've put up an announcement here saying, like, listen, don't troll each other and stuff. No trolls allowed. I will make sure that people get banned from the service if you are trolls. So don't troll. But share ideas, be friendly to each other, support each other, create community. That is the whole idea. All right, any questions, guys? All right, we'd like to say 300, but also looks like support. Oh, 300. Yeah, okay, so 300 is a bit of a level, right? So just off the bat, you can see that 300 level has been, let's make it green. You can see that 300 level was support, resistance. You know what you could do also? If you trade these range trades, I'm going to take a lot of these pictures or these lines away because it's getting a little messy. So what you can do with these range plays, okay, you can say, like, here's a resistance level, right, and here is a support level, and if we get a close in whatever time frame it is that we're looking at, we get a close outside of that range, right, that is a entry for a particular trade. So what would have happened is here you would have been put in short. Okay, so the basic trade here is that halfway through this channel, 260 to 320. Okay, what is half of that? Let's just say 320 minus 260. That is $60. So 30 Rand up. So that is at 290 is halfway. Okay. Well, it'll be a bit higher because it's 22. So it's at 291, 292 is about halfway between, about the midpoint of this range. Okay. So what I'm going to do here, I'm going to make that a stipper lane, and I'm going to make it a bit thinner. Maybe I should make them pink because it's hard to see the green. Make them pink. It took me a long time to be comfortable to use pink on my charts. Anyway, okay, so what you could say is that is now your range, okay? And you've got a midpoint to your range. You can see that midpoint is a bit of a support and resistance level. And it's not a precise level, it's not 300, it's 291. It should be 291.25 because if you use the top and bottom of the parameters that I have in place at the moment. But that's our thing. So if we get so basically we're just playing a consolidation break in this situation, okay? So in this case, what would have happened is you now measure the range of the consolidation, or the height of the consolidation is 19%, 20%, and you forecast that out, okay? Actually, I'm going to do it even more old school. I'm going to draw in use an arrow, okay? I'm going to draw that arrow from top to bottom of this range, and then I'm going to put that arrow right at the bottom here, okay? So that distance is the same as that distance, okay? And this distance is half of that distance. So what we have now is a 1 to 2 risk reward. So we can open a position here, and we say a short position, and we would probably enter a short there, and a stop loss would be there, and our target would be there, right? So we would then enter into this short trade. We could be patient here, and maybe, you know, I mean, you always try to get exactly the level, you never do, but you could maybe do this short trade, right? So your stop loss is then the midpoint of the range, or it would be just above, and your target price is the distance of the range out the bottom. Bang, you got stopped out on the first try, okay? Because that would have legitimately sucked you in as a short, okay? Then now we're in a situation where you can take a long position here. Your stop loss is once again the midpoint of the range, and and this time I'm going to draw an up arrow because I don't want an arrow pointing down. You've got an arrow going up, so you project out where you think it's going to go, right? And you have a target, and guess what that is? That is just under our previous high, okay? And there you've got a risk reward ratio of 1 to 2 with the stop loss in the midpoint of the range, which is a different way of playing it, okay? So this is just a consolidation break. And you would then use the 2% risk model to this, or 1%, whatever it is. So if you stop out, you lose 2%. If you make money, you've got a 1 to 2 risk reward, you make 4% of capital, or 2% if you risk 1, or whatever the case is. Make sense? Yeah? It's funny. 2 hours in, and there's more people watching now than have been watching for like most of the video. But okay, does that make sense, right? I hope so. Any other questions, ladies and gentlemen? Would you like to send me some of your charts for us to look at? Because that would be pretty cool if you could. I'm going to give it some time because I know that there is a delay. What I'm going to do, in actual fact, is I'm going to play some tunes, and I'm going to make some coffee, and then I'm going to come back and I'm going to see if there's any questions and stuff like that. And if there's not, then I'm going to call it a day. If there is, then I'm not going to call it a day. So we're just going to play some of that song. Makes me want to party hard. Okay. Hey, Giuliano! Jules, the legend, the bullish judge. I think that's it for tonight, guys. If there's no more of the questions, then we're going to call it a day. So just to recap what we did, we spoke about the 2% rule. We did a couple of examples on how to calculate them. I'm going to switch on the screen once again. We did a couple of examples on how to calculate the 2% rule. We spoke about how to include your brokerage fee as part of your calculation to work out your 2% rule, and we included that into the examples to work out what your projected brokerage is going to be based on the value of your trade, and the value of trade is based on how many shares you trade, which is derived from where your stop loss is put. and your whole 2% rule. We did that calculation. And then I spoke endlessly about this this maximum exposure rule, which is a bit more of a fund managery kind of way to think, especially if you want to take multiple positions in stuff and you want to never stop out, or you're too stubborn to take stop losses, or whatever the case is. It might be another way of trading, or it is just generally a safer way to make sure that you don't ever get yourself in a situation where you've got too many open trades and you get absolutely wiped out by a move like that, for example. Or I'm again showing examples. A move like that, or you have the situation where you've got 2.5 or 4 times gearing when the market is trading up here, and a move like this just absolutely destroys your account. So you then phase yourself into that. So we spoke about how that works, and then we looked at a couple of trades. We looked at where to put where you would put stop losses, basically at areas of significant support and resistance, and we looked at a couple of examples in that area. Kumba, there was a bit of a range trade breakout kind of situation. Discovery, Firstrand, standard back. Oh, we never actually looked at the Firstrand short. That was a thing. So just to quickly do that. Firstrand, your first significant high, if you wanted to do it here, I would ignore this one. I would say that would be my first significant high. In fact, this entire level is significant. So that would be, I'd put it above those wicks. So that would be my stop loss if I were to short Firstrand at this stage, and that would be the aggressive way, and the conservative way would be above that, because that is your first significant high and that is your second significant high. So 1 or 2 significant highs or lows away from where your entry price is how to do the stop loss methodology. And that, I think, concludes this evening. So thank you guys very much for watching. I think if you hit the little bell button, it will notify you every time a new video is put up, or if I go live, you should get a notification, stuff like that. Also subscribe, like, comment, do all the things, and yeah, let's tell me what you want, join the discords, all that kind of stuff, and then I can keep making stuff that you guys are interested. Jules says he likes ShopRite. I don't know if he likes it for a short or likes it for a long. I tell you what, Jules, join the Discord. The little link is in the bottom. You might have to download an app or whatever. It's really cool. Join the Discord, pop your chart and your analysis on there, and then we can talk about it. And then next week we can look about it, and we'll see if your idea, whatever your trade idea is, we can then see how it worked. Eh? How's that? I like that idea. Same goes for any of you guys. If you would like to do some practice, take 5 or 6 charts. Let's look at the, we recapped last week as well, so let's look at the primary, secondary, tertiary trends in those individual stocks, and then from there we figure out where we put our stop losses, and you can do those things, pop those charts in the Discord, and we can talk about them throughout the course of the week. And that, my friends, is going to be that. I'm going to stop the trade. Ta-da! I'm going to stop the stream right here. I hope you guys have a good evening, and I'll catch you next week.